Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra. Well, everyone knows that an SIP is the most powerful way of investing and building a large corpus for your future and for your retirement. Month after month, year after year, SIPs have helped investors harness the power of compounding and to stay disciplined on their wealth creation journey. But is building a large corpus enough? And once you've accumulated that wealth, how do you truly convert it into a steady stream of income for your retirement years? Can your investments continue to support your lifestyle even after you stop working? And if your goal is to retire early or to achieve financial freedom, is SIP alone sufficient, or do you need to also adopt an SWP strategy? That's the big question that we will decode today. From building just about a 1 crore, 5 crore or even a 10 crore rupees corpus through SIPs to in fact creating a sustainable income stream through SWPs, we will actually be breaking down the formula to help you transform your wealth creation into long-term financial independence. So if your dream is not just to become a crorepati but to stay a crorepati for decades even after your retirement, you've come at the right show. So that's something that we will be decoding today. Joining us is Sanjay Kathuria, financial coach. He's known for achieving financial freedom at the age of 39. He's now guiding millions of people with practical money insights, wealth strategies, and financial freedom tools as well. Thank you so much, Sanjay, for joining in on this special edition. Well, I want to start off by understanding for our large viewers who are watching you right now, as to what was your own successful investment journey, because we talk about how you attained financial freedom even before the age of 40. So what strategy helped you the best?
So thank you, Sakshi, for inviting me. And yes, I attained my financial freedom at the age of 39. But it required a lot of discipline, and it required you to sustain through market ups and downs, and to believe in the fact that, there is a kahavat in Hindi which says कि market और इंसान दोनों ऊपर जाते हैं. So in long run, every markets generally tend to go up, and the developing economies like India, which is growing at the speed of, let's say, 7 to 8% per annum, those kind of economies will grow, consumption will grow, middle class will have extra income, they will consume, the economy will grow. So that belief, if you have, you will have long-term investment horizon. I started my SIP way back in 2008 with a meager amount of 2,000 rupees per month. And I think the best thing which helped me at that time, that we didn't have any apps. We couldn't see what has happened to our NAV on a daily basis at 11 p.m. in the night. And I think that's what helped me keep myself disciplined. Because after 5 years, when I checked my account statement, and I started my SIP in January 2008, and after that, I don't need to tell you what happened to the markets. It fell down by around about 56, 57%. And still, when I picked up my account statement after 4 to 5 years, I made a very healthy XIRR or time basis returns of almost 18 to 19%. So I started believing in it. And during this time, I was investing a lot through stocks, futures and options, and I was not making money there. And I said, wow, was making money so simple? Just keep investing for a long time and you end up making money. So after that, once I saw this magic in 2013, 12, 13, I saw these results, I started doubling down. And from there, I created my own journey of financial freedom. Obviously, times were not great during certain times. You invest in a mutual fund. And I remember I invested in a fund where right from September 2016 till March 2020, there was zero returns. And in March 2020, COVID hit us, and that particular mutual fund went down by 25%. So imagine you're holding something for 3.5 years, and you are now at minus 25% from your average purchase price. I'm not sure how many people would be able to sustain such kind of a shock. And after that, I stuck to the principle. I invested, and that mutual fund today is almost 3.5 times of my investment. So, you have to look at a longer horizon. There'll be presidents will come, wars will happen, currency crisis will happen, everything will happen during this time. But over a long time, you will definitely get a chance to make a good amount of wealth. And the bigger thing which people don't understand is the time involvement and the effort involvement in doing an SIP is next to zero.
Okay, yes, absolutely. You're just deploying your money. You're not deploying your time or your energy in understanding whether you to track it on an everyday basis. That's definitely positive. But I want to start off again. You said that you started off with just a 2,000 rupee SIP. That was way back when the markets were very, very nascent, and many people did not even know there was something called as an SIP. So you were financially aware and you started that right now. Today, as we are looking at how every month SIP figures are increasing, we are at record SIP numbers. That means more and more people are now aware about SIP way of investing in mutual funds. They've understood that this will at least help them create more money, probably create more wealth for their future. But what is the right way of doing it is something that we want to discuss. How much is enough? Usually people start off with a 5,000 or a 10,000 rupee SIP. Is that enough to reach a certain goal? Probably many people don't even realize that, what is their goal when they are starting out an SIP with. So how do you really look at all of those aspects?
I think you need to sit down with yourself first and understand what are your life goals. How do you want to design your life? Let's say you've started earning maybe 30,000 a month or a 40,000 a month salary, and now you want to design your life and say, okay, fine, after 3 years or 5 years, I want to buy my first car. After 10 years, I want to buy my first apartment. After, let's say, 6 to 7 years or 8 years, I want to get married. After, let's say, 15 years, broadly, I'll buy, let's say, my kids will be this age, so I want to get them to education. And I'm looking at, let's say, 20 odd years of work, and then I want to financially retire. I'm 23 today. I want to retire by 43. So you need to plan this entire 20 years, and you need to bucketize each of these investments. And as and when you understand that, okay, this is my goal. So after you finalize the goal, you need to see in how many years that goal is going to happen and what is the requirement of the amount. And it is very simple. It's not very difficult. Let's say you want to buy a car today, okay, and you have a dream car which you think is today valued at 10 lakh rupees. So obviously after 5 years, it will not be valued at 10 lakh rupees. It may go up to 12 to 13 lakh rupees. You may put an inflation of 7 to 8%. So after 5 years, if you want to buy a 12 to 13 lakh rupees car, then there are many SIP calculators available, which will tell you how much, monthly SIP you need to put so that you can reach to that particular goal. I think the bigger issue with people here is that you were right when you said that people just don't know what goals they have. And I tell people, if you don't know very clearly what goals you have, then you should park your money into different assets, because in investment, diversification is something which saves you. If you are very highly concentrated into something, obviously when times are difficult, volatile, you will not be able to sustain such drawdowns. I know a lot of people started investing in small cap funds in 2024, but today they are all very scared, because they don't see any kind of positive returns. But a person who had a bit of money in gold, a bit of money in, let's say fixed deposits or fixed income securities, and a part of this money in equity would have been reasonably okay facing these turbulent times. So I think very, very important is to first understand your goals. And if you're not understanding your goals, diversify your investments and keep on investing into those assets for a long time.
Okay. Two questions from what you said. One, say for instance, if somebody does not understand what their goal is, say a basic goal that most people start off with is, I want to create a corpus of 1 crore rupees. And I can start off now. And I need to know how much time will it take me? How much money do I need to invest in every month to reach that goal? What do you tell such people?
See, once year, if you have finalized, then you need to finalize two things. One is how much you're going to invest, and second is how long you're going to invest. Okay, so I'll give you 3 scenarios, and I'm assuming a 12% CAGR, a little lesser than what Nifty has given us in the last 5 years. Let's say you say that I want to have my first 1 crore in 15 years. Okay, so in that case, you need to invest 14,000 rupees per month for a span of 15 years, and you need to step it up by 7% every year. If you invest 14,000 a month, step it up by 7% every year, you will reach your 1 crore goal in 15 years, provided you get 12% returns. However, you say, nahi yaar, 15 is too long. My God, I can't wait for that long. I want to have it in 10 years. Great. Then this 14,000 becomes 34,000. Okay. So now you need to invest 34,000 rupees per month for 10 years and step it up by 7% per year. I'm not taking 10% step up because 10% step up is not feasible every year because of the compounding compounding effect. So I'm taking a 7% CAGR. I think people get their salaries also increased by 7% CAGR approximately during their lifetime. Apart from that, now you say, no, I don't want to wait for 10 years. I want to become a crorepati in 7 years. Great. Now your investment goes to 54,000 rupees a month and you have to step it up by 7%. Now just look at this, depending on how much you want to invest, you need to see what your income is. So let's say if I want to invest 54,000 rupees a month and my savings rate is, let's say 25%. So in that case, my income has to be 2 lakh rupees a month. So if I make 2 lakh rupees a month and I have a savings rate of 25%, that is when I can invest almost 50,000 rupees a month. And in case of 34,000, that number comes to around about 1,20,000 rupees a month salary. But in case of 14,000, that number comes to around about 56,000 rupees of salary. So point of matter here is that even if you're earning, let's say 40 to 50,000 rupees, you can achieve your dream of becoming a crorepati. And it may take some time. It may take 12 years, 15 years, 18 years. But the moment you get your first crore, the next crore ends up coming in 5 to 6 years. And the next crore ends up coming in 2 to 3 years. The magic starts happening after that 1 crore rupees. And for that, you need to be disciplined. You need to, and Charlie Munger used to very famously say that the first $100,000 is a bitch. Earlier, that $100,000 used to be $80, but now it's all 100. So you can say 1 crore now, very simply. So the first 1 crore is very, very difficult. It is going to be difficult. It's not an easy journey. You will see a lot of volatility. There will be times you want to withdraw your investment. There are times you are not encouraged to do your SIPs because the markets are not doing well. But in all this noise, you need to see what is the right signal, and the right signal is stay long and stay invested. You will definitely get good returns over a long period.
Okay, so you have helped all our viewers understand what is the time horizon and how much appetite do they need to have to invest monthly to achieve that 1 crore. But when we start this SIP, again, is it going to be diversified, which you were earlier talking about? Is it going to be in just one kind of a mutual fund or an index fund or something? How would you advise that? Where does that money go? 14,000, 34,000, 56,000, whatever money you have talked about today, where does that money go every month? How do I decide that?
See, a lot of people think that, putting 100% in equity funds will make me rich faster, but that's not the case. And that is because equity, when they have significant drawdowns, it takes a huge amount of time to come back. So let me give you a very simple example here. Let's say you invested 100 rupees and the market's corrected by, let's say 20 rupees. Okay. And your 100 became 80. Now to go back from 80 to 100, you need a 25% jump. Okay. But if you were well diversified and you had debt in your portfolio and gold in your portfolio, let's say your portfolio went from 100 to 90. Now, from coming back from 90 to 100, you need only 11% increase. So what is easier, So easier is that you will be able to increase your returns by 11% as compared to 25%. It's like, let's say you're walking on a road and you fall in a pit. If the pit is 3 feet deep, you will get out of the pit. But if the pit is 10 feet deep, obviously, it will be very difficult to get out of that pit. So don't focus on 100% equity. It's a very, very risky strategy. When you're a long-term investor, you should look at diversifying your portfolio. Now, if you don't understand how to diversify, I don't understand Nifty, all these things, small cap, mid cap, don't worry about it. There are a lot of categories of mutual funds. For example, you can pick up a multi-asset allocation mutual fund. If you pick up a multi-asset allocation mutual fund, as the name suggests, you have equity in that, you will have gold, you will have silver, you will have debt, you will have international investments. Everything will be there in that one multi-asset allocation fund. But if you don't understand that and you want debt, equity a bit different, so very simple, what you can pick up is a balanced advantage fund, and you can pick up some gold with that. So balanced advantage fund gives you access to equity, debt, and you can add a bit of gold to it. I think you are reasonably sorted. But then you say, no, sir, I'm looking at having equity differently. I'm looking at having debt differently. In that case, you can pick up a nice multi-cap fund, because multi-cap fund compulsorily gives you access to mid-cap and small cap also. So you can pick up a multi-cap fund, and plus you can pick up some arbitrage fund or a liquid fund, and you can pick up gold. So what you are trying to do, please don't focus on creating a zoo of 40 mutual funds. A lot of people come to us when they have like 35 mutual funds, 40 mutual funds, 80 mutual funds. Why? Because they were all chasing returns. They were all chasing, okay, which was the best mutual fund, what was the best performing mutual fund of the last quarter? Everybody asks me, which is the best mutual fund? I think the question should be, which is the right mutual fund? The right mutual fund is the one which is for your suitability. In financial products, you have all kind of products. I call my mutual fund industry as it's completely a buffet. You can choose anything. You can choose extremely meetha, you can choose extremely tikha, you can choose a khichdi which is bland, you can choose anything in our portfolio. But you have to see whether that suits you or not. Okay, so you have to look at the risk return. You have to understand whether I will be able to handle this kind of volatility. Do I need a fixed income? I love a scheme which I would recommend to everyone to look
Sure.
at least, which is called Equity Savings Scheme Fund. Now,
Acha,
Equity
okay.
Savings Scheme Fund is for somebody who can't handle volatility, but still wants a little bit of participation in equity.
This
Out
is
of 100
different from
rupees in,
ELSS, which most people
yes,
understand
yes.
as a tax saving fund. Okay.
No, I'm not about tax saving. This is different from tax saving. The beauty about this particular fund is that it has 25% exposure to equity, direct equity markets,
Okay.
40% exposure to arbitrage, which is almost fixed income, and 35% is your debt funds. So in a way, this is a 75% fixed income, 25% equity. So in that case, what happens if a person is not very confident, he wants to just enter the markets, can't handle a lot of volatility? This mutual fund is brilliant because it is categorized as equity mutual fund. You get the taxation advantage of long-term capital gains and short-term
ठीक
capital
है.
gains.
Okay.
So this is a category which gives you 25% access to equity. Then if you come to balanced advantage fund, it gives you access to 65% equity. If you come to aggressive hybrid, it gives you access to 75 to 80% equity. So आपको कितना equity चाहिए? How much equity do you want? There are so many different categories of funds which can give you different level of accesses to different level of equities based on your risk return and your volatility tolerance levels.
Okay. So, in the first part, we've tried to understand how much do you need to start your SIP with for your particular goals. If you have a 1 crore goal, in how many time frames you can look at it, what kind of funds should your SIP go into according to your risk appetite as well. Those are many varieties that Sanjay has highlighted. We have the multi-asset, the multi-cap, the balanced advantage fund, ESS, so many funds he's talked about. And now we will try to understand whether SIP alone is enough, or do you need to have a strategy with SWP that Sanjay you have talked about a lot in your own videos as well. Just when everybody was starting to learn about SIP, you brought in the world of SWP as well. So give our viewers an understanding of what are they missing out on in case they're only doing SIP with a focused goal that, okay, till the time I create 1 crore, I will continue my SIPs. But what about SWP? How do we understand that?
So, see, SWP is anything where you withdraw. Even an EPF, Employee Provident Fund, is an SWP. Even a FD, in a way, is an SWP. Anything where you withdraw from is known as Systematic Withdrawal Plan. But before I reach there, I want two things for my viewers to realize. See, first thing which you should do is, when you do an SIP, there are two things which you have to do, else you will never be able to meet your retirement goal. The first thing which you have to do is you have to step up your SIP every year.
Yes.
I think this is one thing which people miss out. See, you talk about inflation. Will 1 crore be enough at that time?
Yeah.
It's not the question that 1 crore will be enough at that time or not. Is 1 crore enough to take care of your expenses on that day? That day is the bigger question. And that happens that you can mitigate by increasing your SIP by at least the rate of inflation, which is in the range of 6 to 7%. So every year, try to increase your SIP by 6 to 7%. Second, whenever you get a windfall gain, which could be a bonus, which could be you have changed your job, you got a 30% hike or a 40% hike, please don't put all the money into lifestyle upgrade. Please put a part of that money into SIP. So suddenly, let's say you were doing 10,000 rupee SIP, your salary was 40,000 rupees. Now you changed your job, you got a 80,000 rupee salary, which is almost a 2 times hike. But now your SIP, what you have done, you have put your SIP from 10,000 to 12,000. That's not right. Move your SIP from 10,000 to 20,000 rupees, because your salary has increased by 2 times. So even your investment needs to increase by 2 times. This is one mistake people make, because then what happens, there is a mismatch between your lifestyle and your investment level. Now this investment level will not be able to sustain your renewed lifestyle because of the salary increase. So I think these are the two things which you need to do in your SIP, which two mistakes, people generally do. Now coming to SWP, SWP is more powerful than SIP because SWP gives you the power to withdraw and the power to continually compound your corpus so that you have legacy wealth for your kids or whomever you want to give that money to. So let's say if I take a case of 1 crore rupees, and I have 1 crore rupees in my bank account after 15 years of my SIP, and I start withdrawing from that. And I start withdrawing from that at the rate of 75,000 rupees a month. Okay. Now, after 20 years, I would have withdrawn 75,000, that's 9 lakh rupees a year. Into 20 years, I would have withdrawn 1 crore 80 lakh rupees. So I had an opening balance of 1 crore rupees. I withdrew 1 crore 80 lakh rupees. And if my money still compounds at 12%, my final corpus will be in the range of 3.5 crore rupees. So I had an opening balance of 1 crore. I withdrew 1.8 crore. And still I'm left with 3.5 crore rupees. And that's the power of systematic withdrawal plan and compounding, because what you are withdrawing is lesser than the rate at which you are compounding. And that is the magic of compounding. So if you have a corpus and if you want to plan your retirement, so a lot of people come to us at the age of 50, 55, and they tell us, sir, we have an apartment worth 2 crore rupees and we are getting a rent of 15 to 20,000 rupees from that. And they are very happy because they consider this as passive income. Now, once they become old, it becomes very difficult for them to manage that apartment, to get a new tenant. There are vacancy levels, there are breakages, there are maintenance charges. So I tell all my retayees that don't have a second apartment. Always have your first apartment, which is your primary home of residence, and you don't want to be there. But if you have another apartment or anything, any real estate where you're trying to generate rental returns for passive income, better than that is take this money, put it into right mutual fund categories. We call it the well and bucket strategy. Put the well and bucket strategy through, and then from that start withdrawing. You will be able to withdraw more. There will be no liquidity concerns. There will be no hassle with the tenant. There will be no maintenance charges. There will be no vacancies. There will be no brokerage charges. There are a lot of advantages, and you are old. You want to enjoy your life. This is your last set of innings where you really want to travel, explore the world. You have worked very hard, taken care of all your responsibilities. Now you want that a fixed amount of money comes to your pocket so that you can easily live your life happily and without any stress. So I think I would request all retirees or people who are planning their withdrawals to not look at purely real estate as an angle, and especially an apartment. It's better that you can design a systematic withdrawal plan corpus and you can start withdrawing from that.
Okay, fantastic. So now we've understood what is SWP. Now a lot of people would have an question that, okay, when do I decide when I have to stop my SIP and start my SWP, or will both continue go on continuing for the rest of my life as well? What exactly do you advise people there?
See, if you do not require any cash flow, if you have alternate sources of cash flow, don't start your SWP, because the moment you start your SWP, you are breaking the compounding. Okay, so you're withdrawing. So imagine you have a very, very large bucket of water. Okay, and it is self-increasing water because it's compounding every year. Now suddenly you poke a hole at the bottom of this bucket, and there's a leak. Yeah, it starts leaking. So obviously, even if it is self-generating, the leak will reduce the value of that particular bucket. So if you have any alternate source of income and you are able to generate money, you have an active income, please don't focus on systematic withdrawal plan. Systematic withdrawal plan is the day when you say that, okay, I have enough money, I don't want to work for anyone, I'm not sure how many months or years I can I will get a new job, or I want to start my own business. It will take some time for me to generate new cash flows from my active income. That is the time you need systematic withdrawal plan. But else, if you do not require it, please do not touch it, because the magic of compounding will keep on happening. So yes, if you have some life goals, you want to travel, those kind of things, that's different. Then you can withdraw. But else, if there is no need to withdraw, I generally suggest people don't withdraw. Just keep that money sitting.
But how much is enough? How do we decide how much is enough? Because right now we're talking about 1 crore as the base, but you also pointed out maybe 10 years, 15 years down the line, 1 crore will be nothing in that kind of a lifestyle. We have 7% plus inflation every year. So how do we decide what is the corpus do we need to reach to be able to now decide that, okay, now is the time that I have enough and I can start SWP?
So see, I believe we talk about financial freedom. I believe there are 4 major pillars to financial freedom. The first pillar to financial freedom, and people say that, I want to have 10 crores, 5 crores, 3 crores. I think all that comes very late. First pillar of financial freedom is having your right amount of emergency fund. People are missing out on that. 76% of Indian workers are living paycheck to paycheck. So that means put 4 people in front of you. There's only one person who will survive a salary loss. Because if something happens to that person's salary, and if he has emergency funds with them, they can weather it out. So I think financial freedom starts when you have 6 months of emergency fund. That means whatever your expenses are for 6 months, you have it in safe in a fixed deposit or a liquid fund sitting there. If something happens to your job or your income, you can take that.
Sure.
Second pillar of financial freedom is having the right health insurance, because people feel that the emergency fund is enough, but if they don't have an health insurance, this emergency fund can just vanish overnight on a disease or on a treatment or on an operation. So I think the right amount of health insurance is necessary. And I think for India today, minimum 10 to 15 lakh rupees is the amount everybody should have with themselves as an insurance cover, health insurance. Third is, if you have any kind of liabilities, you have kids, you have a mortgage, you have these kind of things, then you should have adequate life insurance. So life insurance, if something has to happen to you, the money will take care of your financial obligations. Obviously, emotionally, nobody can take care of the loss, but at least financially, you would be able to take care of your family even after you leave leave the world. And then comes third pillar, which is being debt free. I think this is another very underrated segment of financial freedom. People think that they will become financially free, but then they have a home loan, they have a car loan, they have an iPhone loan, they have a vacation loan, they have a home renovation loan, they have a loan against property. They have so many loans. How can you become financially free when you have a loan on your head? So if you have a loan, you cannot become financially free. So get rid of all your loans before you become financially free. And fourth comes that amount which I require in my bank account or my mutual fund account, from which I can withdraw every month and still don't worry about my life after that. And that amount, to calculate, you need to have a calculator. In that case, very simple mathematics. The simple mathematics says that whatever is your expense today,
Okay.
whatever is your expense today, you have to extrapolate these expenses to, let's say, 15 years down the line. You want to become financially free in next 15
Say
years?
1 lakh rupees is the expense for somebody in 1 month. Then.
Okay. So if 1 lakh is the expense, then you need to add two types of inflation. The first inflation, okay, so let me come back. In this 1 lakh rupees, reduce all your obligations which will finish over time. So what will finish over time? Your kids' education will finish over time. You don't need to pay that. Okay. Once you're financially free, your kids would have got educated. That's what my assumption is. Second is, if there is any kind of home loan EMI, that should be subtracted. Third is, if there is any kind of car loan EMI, that should be subtracted. Because by the time you become financially independent, all these expenses will not be there. That's another mistake which people do. And that's why on internet, sometimes I hear that you need 40 crores to retire. It's just not possible for 99.9% of India. It will never be possible. And to listen to such things, people get very highly demotivated.
Yes,
That,
absolutely.
life I cannot become financially free. So it's very logical calculation that whatever you're spending today, reduce the expenses which will not be there after 15 years. Which could be, again, I will say, which could be kids' education, which could be EMIs, any kind of these kind of expenses will not be there. So for example, out of 1 lakh rupee, now my household expenses, which as a couple between me and my wife we require once we become financially free, is, let's say, 50,000 rupees.
Correct.
Then that 50,000 rupees has to be adjusted for inflation. Now there are two types of inflation. The first inflation is known as general inflation. So general inflation, let me put in very simple words, is, let's say last year I used to have Amul milk. Okay. And Amul milk was 50 rupees per liter. This year also I'm having Amul milk, but now it's 53 rupees a liter. So that means the general inflation is 6%. However, there is a lifestyle inflation. Last year I was having Amul milk. This year I'm starting having A2 milk. So that A2 milk is now costing me 60 rupees a liter. Okay, so that is called lifestyle inflation, that you change your lifestyle. So what I suggest to people over a long term, take a healthy inflation at 5 to 6%, your normal inflation, general inflation, and 2 to 3% per annum of your lifestyle inflation.
Lifestyle inflation.
So let's say we add the two, it comes to 8%. Now take this 50,000 rupees, compounded by 8% for 15 years. Okay. So let's say, give or take, this will come to 1.3, 1.4 lakh rupees per month. So once you decide to retire, you will require let's say 1.5 lakh rupees a month. Okay. So 1.5 lakh rupees if you require, that means annually you require 18 lakh rupees to sustain your lifestyle.
Correct.
18 lakh rupees into at least 25 times should be there with you, because we follow the 4% withdrawal rule. Okay, so even if I withdraw 4% from my corpus every year, I will not run out of my corpus for 25 years and I will keep on compounding the money. So I will never run out of my money. So if 18 lakhs into 25, so give or take, let's say 20 lakhs into 25. So I need 5 crore rupees to become financially independent in the next 15 years. Okay, now how do I get that? For that, I need to have an SIP of 70,000 rupees, the equation I gave you earlier. if I require 15 years. So from 14,000, I was able to generate, let's say, 1 crore. So
1
to
crore.
generate 5 crores, I will require 70,000 rupees. So give or take 70,000 rupees SIP stepped up by 7% every year will make you financially free very, very beautifully in India.
Fantastic. I think that's what investors truly needed. A very concise masterclass that you have been able to give today in just about 30 minutes in the session. But we'll keep on having such conversations for more and more viewers to understand what's the best way, ideal way to really reach that financial goal of being financially independent, just like how you've done, Sanjay. Thank you so much. Appreciate your time as always on Business Today to seek such wonderful practical tips that you have to share with our viewers.
Thank you, Sakshi, and wishing all BT viewers a very, very happy investing season. Thank you.
Thank you so much. Thank you. All right, viewers, I hope that you had enough and more to really take down. Please do visit our website, our social media platforms. We'll be cutting out a lot of chunks from this to revisit this, to find out how you should be devising your own investment strategy suited to your own lifestyle right now to be able to reach that financial goal of retiring early, of creating a good corpus for your future, also being able to sustain an monthly income even after you retire, so that you can continue to stay in the same lifestyle with all the formulas that Sanjay has shared on this edition. We'll wrap it up on that note on this special edition, but stay tuned on to Business Today Television. Much more coming up on your screens ahead.